Welcome to the MMA webinar entitled Money on the Table, Use the Employee Retention Credit and the Paycheck Protection Programs to Your Advantage. I'm Mike Johnston, VP of Government Affairs of the Michigan Manufacturers Association. We appreciate you all participating in the webinar today as we continually work to serve our members. MMA represents about 1,600 members in the largest sector of the Michigan economy. Our members include the largest iconic companies you all recognize: Ford, GM, Stellantis, Kellogg, Ford, US Steel, etc. But 85% of our members have 100 employees or less. Manufacturing employs 628,700 people in Michigan and generates $102.35 billion in total manufacturing output. A little housekeeping to get started. This is a Zoom webinar. It's formatted to allow a lot of people to participate. We have about 100 registrants today, and we're pleased about that. Everyone on the call will be muted. However, you'll be able to send questions during the call through the Q&A function at the bottom of your screen. We'll address all the questions along the way, but also reserve time at the end for questions. Our presenters will speak for about 30 to 40 minutes, reserving the last 20 minutes for Q&A. In addition, our experts from Clayton McKervey have offered to continue to respond to questions posed through the Q&A function, even after the video portion of the webinar has ended. This webinar is being recorded, and we will send it to you within 24 hours. It will be also available on our website in the learning section, and so we encourage you to take a look there as well. So let's get started with the program. The Consolidated Appropriations Act of 2021 retroactively allows employers to take advantage of both PPP dollars and claim a credit under the Employee Retention Tax Credit. This is a very important news for many manufacturers and many employers across the state. Today, we are lucky to have two shareholders from Clayton McKervey accounting firm to walk you through those changes and make sure you don't leave any money on the table. Clayton McKervey is a premium associate member of MMA, and we're pleased to introduce our experts. Jim Biehl is shareholder focused on manufacturing and distribution, and Sarah Russell is shareholder and focused on tax. With that, Jim, I'll hand it over to you and let you educate our members.
Thanks, Mike, for the introduction. Sarah and I want to welcome everybody and thank you for joining the session on the Employee Retention Credit and the interplay of the credit with the PPP loans. As Mike had said, I head up our manufacturing and distribution group, and I'm not sure if any of you are in the same situation that many of my manufacturing clients are, which I label they're in a situation of PPP fatigue. They've dealt the last year with the PPP loans, everything from calculating how much money could they get, how do they go through the application to get the money, the covered period, the forgiveness, and even some of them are going through on the needs side of it. So when the law changed in the end of December and we had the new rules relative to ERC, and I approached many of my manufacturing clients, there were a lot of blank stares that came back at me. They weren't really excited, or at least as excited as they were on the PPP. And part of our role, Sarah's role and my role when we were talking to our clients, was to hopefully get them excited. I don't know if we got them excited, but at least explain the rules in a simple way that they can understand what the benefit is. And we think there's a big benefit here on the ERC. And the goal today is possibly get you excited, but if not get you excited, at least be able to determine for 2021 how the rules apply to you, whether you qualify, and how much money you can get to put in your pocket. Because in these COVID-19 times, I think it's important for all of our manufacturing companies to get as much money as they can in to protect from the downside as we continue to roll through COVID-19. Couple logistic things before I turn it over to Sarah. As Mike said, Q&A, the questions are down at the bottom. Please start firing questions out. We'll try to cover them as we move through the material as well as on the back end. So I try to tabulate those as Sarah's going through the presentation and try to pull them up as we move through. So please do that. The other is our contact information is on the last slide that you'll see. You'll get that after the session. But we are more than happy to also answer any calls, any emails that come through at a later date. If tomorrow you want to give us a call, we'll try to answer your questions as best we can. So we've got a fair amount of material to cover, and I will turn it over to Sarah to start to walk through the presentation. Sarah?
Thanks, Jim. So we're going to start today first, we're going to sort of go through the old rules that were established as part of the CARES Act in March. And the reason why we're going to do that is because there may be an opportunity, if you meet the requirements under those rules, to go back and amend payroll tax returns and potentially get some money back. When they passed the Appropriations Act at the end of December, it allowed companies to take advantage of both PPP loans and the employee retention credit. And so I think it's important that we not skip over the old rules and go right to 2021, because there is an opportunity out there for those of you that qualify for the employee retention credit to potentially get some refunds back. So if we look at what happened under the CARES Act, as Jim said, PPP fatigue is a real thing. I think I suffer from it a little bit myself, but the CARES Act established two programs. One was the PPP program, and the other one was the employee retention credit. And I think the employee retention credit was sort of overlooked because everybody was really looking at taking advantage of the Paycheck Protection Program instead, rightfully so. And once the Consolidation Act passed and allowed you to take advantage of both, it hasn't, I don't think a lot of people have gone back to see how they qualify. So we're going to go through that today. So what is the payroll or the employee retention credit? It's a refundable payroll tax credit that's available to certain businesses. You qualify if your operations were partially or fully suspended due to COVID. And we're going to talk about what that means in a little bit. Or they experienced a drop in gross receipts. And we'll talk about what those rules are in future slides. You can't take advantage of PPP and the employee retention credit on the same wages. So if you filed a loan forgiveness application for PPP, you can't claim the employee retention credit on the wages that you included in your loan forgiveness application. There are some clarifiers that we'll talk about as we move through the slides there, though. So I sort of already covered this. When I started talking to my clients about the employee retention credit, they were like, Sarah, I don't have the time or the energy to deal with this. I don't think it's going to be worth it. It doesn't sound like big dollars. But when we actually took the time to crunch the numbers, we realized pretty quickly that it was worth spending the time. I have a client who is qualifying for, upwards of $1 million worth of credit. And so, the way the calculations work, the numbers add up really quick. So I would advise you to understand the credit, how it's calculated, and to go through that exercise to crunch the numbers to see where you would end up. The rules are different for 2020 compared to 2021. So it adds a little bit of confusion, and you need to make sure that you're applying the right set of rules for the right year. The refunds are available for 2020 by amending your payroll tax returns. So whichever quarter you qualified, you could potentially amend your 941 to get a refund back. And in 2021, it's easier to qualify than it was in 2020. So make sure you do the full analysis. So in 2020, the credit was 50% of payroll costs in an eligible quarter, up to a maximum of $5,000 per employee for the entire year. To qualify for an eligible quarter, you either had to be shut down, either a total or partial shutdown due to COVID-19 under government orders, or suffer a 50% drop in gross receipts in the calendar quarter of 2020 compared to the same calendar quarter of 2019. Once you have a qualifying quarter, you will qualify in all subsequent quarters until such time when your gross receipts are greater than 80% of the 2019 amount. So if you qualified in quarter 2 of 2020 and your gross receipts in quarter 4 were 79% compared to quarter 4 of 2019, you could potentially qualify for quarter 2, quarter 3, and quarter 4, with the caveat being that the maximum credit is $5,000 per employee for the year. I think that this piece is important because this is where most of my clients were qualifying was they had the PPP loan, which covered them for quarter 1, quarter 2, quarter 3, But by the time the end of quarter 3 came around, they had fully exhausted their PPP funds. And so they looked at it and said, well, quarter 4, my gross receipts haven't recovered. I'm less than 80% of what it was in 2019. So now I qualify for the employee retention credit in Q4 2020. So, doing those analyses is important to understand which wages you want to use for the credit. Payroll costs are different for small employers and large employers. And we'll talk about those definitions in a minute. Gross receipts reduction, all wages, and so payroll costs include all wages and healthcare costs that were paid. But if you were shut down and you're a large employer, only wages and group healthcare costs paid while you were shut down would qualify. So a large employer versus small employer, there's different qualifications. And a small employer is any employer with 100 or less employees. If you have greater than 100 employees, you are considered a large employer. And if you have greater than 100 employees, then only wages paid to an employee to stay home and not work are eligible. If you are 100 or less, all wages paid to an employee, even if the employee is at work, would be eligible wages.
Sarah, one of the items on here as well is you have to look at the gross receipts as well as the FTEs for the full-time large company or small company on an aggregate basis. So parent, sub, brother, sister, you have to look at the rules under code section 52A and 52B or 414 M or O, which relate to sort of the retirement plans. And that can trip you up a little bit. So you got to make sure you look at the whole group, but once the group qualifies, then you're pretty much in.
Yeah, that's right. And I think we're going to cover that in a little bit more detail in a few slides. So that's the credit for 2020, and those are the qualifications. For 2021, the credit increases. It's now 70% of payroll costs in an eligible quarter, up to a maximum credit of $7,000 per employee per quarter, or a total of $28,000 for 2021 if you qualify for the credit. And so not only is it richer, it's also easier to qualify. In order to have an eligible quarter in 2021, the taxpayer had to either be shut down, a total or partial shutdown, or suffer a 20% drop in gross receipts in a calendar quarter 2021 compared to 2019. We're still going back to 2019 for the comparison quarter. And the taxpayer for 2021 has the option of electing to look at the immediately preceding calendar quarter to test the gross receipts eligibility. So you could look at Q4 2020, and if your gross receipts was less than 80% compared to 2019, then you could take the employee retention credit in Q1 2021. The payroll costs, the same, gross receipts reduction, all wages, and if you're qualifying based on gross receipts reduction, generally all wages and group healthcare costs paid if you're a small employer, and if you're shut down and you're a large employer, then only wages and group healthcare costs paid while you're shut down will qualify, not while you're shut down will qualify. And they've expanded the small employer definition so that it is 500 or less, your average monthly full-time equivalents in 2019. If they're 500 or less, all wages paid to an employee, even if the employee is at work, would be eligible wages. If you're over 500 employees, then only wages paid to an employee to stay at home and not work would be eligible. And Jim is right, there are aggregation rules. So if you have multiple related companies, then you would need to test your gross receipts drop on an aggregate basis. I have had clients who thought that they were going to qualify, and then once they did an aggregate, they had one company had a drop in gross receipts that would make them qualify in one quarter, and the other company had a gross receipts drop in a different quarter that would make them qualify. But when you aggregated all of the revenue together, no quarter had a drop of gross receipts, and so they didn't qualify. So the aggregation rules are definitely important. They're a little bit more complex. We don't have time to cover all of the details for the aggregation rules in this presentation. The other part of the aggregation rules, though, that also are applicable are to determine if there was a full or partial shutdown. And we're going to cover that in the future slides when we talk about what that means. But you'll see that it's really important. So the aggregation rules can be detrimental, but they could also potentially be beneficial.
And Sarah, they also can be beneficial if the overall group has a reduction. Even the individual entities underneath that didn't have that 20% reduction still qualify as well. So once the whole group qualifies, it goes back. So one of the group can make the whole group qualify, which is kind of a cool thing as well.
That is also correct. Yep. So what is partially or fully shut down mean? The IRS has issued FAQs, notices to sort of go through these, what they determine to be a partially or fully shut down. They go through several examples. We're going to cover them, not all of them. You will get the slides will be available. So we've linked some pretty important resources that we utilize to help our clients go through the determination of whether or not there was a full or partial shutdown. These will be linked here in the slides here. So you guys will have that as a resource going forward. IRS Notice 2120, if a government order requires non-essential businesses to suspend operations, but allows essential businesses to continue operations, is an essential business considered to have a full or partial suspension of operations? As we probably know, a lot of the manufacturers in the area were deemed essential, and so they did not have to shut down. But really, a lot of our clients, part of the business was deemed essential and another part wasn't. And so they may have only been able to operate a segment of their business. So, the answer is, if under facts and circumstances, more than a nominal portion of its business operations are suspended, then you would have a partial shutdown. And the IRS has sort of said, hey, if your gross receipts from that portion of the business are not less than 10% of total gross receipts, or the hours of service performed by employees in that portion of the business are not less than 10% of the total number of hours performed, then you may have a partial shutdown. Of course, if your operations were fully able to remain operating and all of your employees were at work and on the lines, then you probably didn't have a shutdown of your business under this notice. So what else would be qualified? One of the other examples they said, if a government order causes your supplier to a business to suspend their operations, is your business considered to have suspended operations due to a government order? And the IRS has said it might. It depends on the facts and circumstances, but if your supplier is critical goods or materials, then probably yes, because you can't operate your business without those critical goods. So even if you didn't have to shut down your operation, it is possible that you would still have a partial or full shutdown. The IRS has said, though, if you voluntarily suspended operations due to or reduced your hours due to COVID-19, for the health and welfare of your employees, but it was voluntary, then no, you are not deemed to have a partial or full shutdown. What else have they said? Is an employer that operates a trade or business in multiple locations and is subject to government orders requiring full or partial suspension of its operations in just some jurisdictions, but not others, are you considered to have a partial suspension of operations? And the answer is yes. So you could have operations in a state like Arizona that didn't really have a big shutdown in their state, and you could have operations in Michigan, which we all know was pretty shut down in the spring. And if that were the case, Arizona being operating wouldn't, you would still qualify as having a partial shutdown. And once you qualify one business in the aggregate group, all of the aggregate group would qualify. So if you're a small business in 2020 with less than 100 employees and you had 2 operations, one shut down and one that wasn't, you could potentially take the credit for all employees across all jurisdictions because you have this partial shutdown. You've met the partial shutdown requirement, and now you qualify for the employee retention credit for the period in which you were shut down. So, we sort of said, hey, the determination of a significant decline is based on the aggregate group. So is the full or partial shutdown. In general, and I said, hey, the aggregate group rules are pretty complicated. We don't have enough time to go over them. But in general, if you have at least 80% common ownership, you probably will have an aggregate group. And as Jim said, you could have one member of the aggregate group have a significant reduction in gross receipts, which qualifies the entire group, because when you add all of the gross receipts of each company in that group together, you could have a greater than 50% reduction gross receipts in 2020, or greater than 20% reduction of gross receipts in 2021. Similarly, it could blow you out of the water and you might not meet the test because other members of the aggregate group did fine, and so you didn't meet those requirements. So, and just a reminder, you compute calendar quarter for 2020 versus 2019 and 2021 versus 2019. 2019 is always the reference period that you're going back to determine if you have this eligibility. So what do gross receipts include? Sales, net of returns and allowances, income from investments, rent, royalty, other income. It's really almost any type of income, regardless of whether or not you're generating rent or royalty income as part of your main line of business. You have to include all of that income to determine whether or not you've met this gross receipts test. So the important thing, this is where we've really done quite a bit of consulting and advising our clients, is how does the employee retention credit and PPP interact together? We know that you can't allocate the wages that you take for forgiveness to employee retention credit. So there's some modeling that we've been doing to say, let's lay out our covered period. What are our wages? What are we, if you haven't applied for forgiveness, what wages do you want to allocate to PPP? What wages do you want to allocate to employee retention credit? The IRS allows you to make that determination. And so what you want to make sure you're doing is maximizing your other costs that are allowable under PPP and that are included in your PPP forgiveness. You want to isolate costs and periods without overlap, and identify, when you're looking at the employer retention credit, if you haven't already applied for forgiveness, identify if you have an eligible quarter for employer retention credit that's included in your covered period. Because if you do, you may be able to say, well, I might be able to maximize my loan forgiveness if I don't allocate these wages, because my loan forgiveness period is 24 weeks and I only got 2.5 months worth of wages in my loan. So potentially you could maximize both the employee retention credit and your loan forgiveness in the same period, just by, sort of stratifying your wages in between 2 different periods that are all included in your covered period. Because you don't have to, say your covered period started on April 1st and ends on, I don't know what that 24 weeks would be, but say it's August 30th. For ease, you might, if you qualified in Q2, I would look at it and say, would my wages in Q3 be sufficient enough to get me maximum loan forgiveness? And I have had some clients where that was exactly the case, and they qualified in the April-May period because they were shut down. So they had wages. And at the time, some of our clients paid their employees for the first couple of weeks at least, because they weren't, nobody was certain what was going to happen or how long they were going to be shut down. Originally, we thought we were just, people thought they were just going to be shut down for a couple of weeks. And then it sort of dragged on. And then we had a lot of employees that were furloughed, or a lot of clients had furloughed employees, but they continued to pay their healthcare costs. And so they had a chunk of wage base that would qualify for the employee retention credit. And so they looked at it and said, hey, I'll take the employee retention credit on this 4 weeks of payroll costs, and then I'll allocate the next 20 weeks to my PPP loan forgiveness. And that's okay. The IRS has allowed you to do that.
And Sarah, also with the extension of the ERC, depending on whether you qualify on the extended quarters, you might have some more options there as well, prior to the recent law change as well.
Yeah, for sure. In 2021, so originally in the Consolidation Appropriations Act, they extended the employee retention credit for Q1 and Q2 only in 2021. The latest round of stimulus that was passed just a few weeks ago extended that even further through December 31st, 2021. So the entire year 2021, you can look at each quarter and determine whether or not you qualify. So if we remember, for PPP purposes, there's a lot of different qualified costs outside of wages, and you could qualify for full forgiveness by allocating, as long as you had 60% of the money was spent on wages. The other 40% can be used on non-payroll costs. And we're not going to get into too much conversation about what's a qualified PPP cost, but every round of stimulus seems to open the door a little wider for what you're allowed to use PPP funds for. When I remember when the PPP program first came out, I talked to some people and as well, my rent and, these utilities, those costs aren't that high. So really what I need to spend it on is wages, because I'm not going to have enough other costs anyways. They keep opening the door a little wider for what they consider to be qualified costs. And now there's a substantial amount of things that you could include in that 40% number. And so it's important to lay that out. When we were first doing some loan forgiveness applications in the fall, a lot of our clients said, hey, I'm just going to put my wages on here. I don't need to put the other costs because I have more than enough wages to qualify. And thankfully, and we'll talk about this in a minute, thankfully I had recommended to my clients to, I put as much as you can on that loan forgiveness application. That way, if there's any question on any of the costs that you've put on there, you'll have plenty, because we knew you couldn't submit a second loan forgiveness application. You got one chance to do it. And so a lot of my clients included all of the costs, even if they didn't need those costs for loan forgiveness because the cover period was so long. So things to, you're going to maximize your PPP forgiveness and your employee retention credit. It's, maximize that 40% covered non-payroll costs. Use non-wage, non-health covered payroll costs for PPP. So that means 401k contributions. And really that's the biggest one would be 401k contributions. Those are not qualified payroll costs for employee retention credit. Use wage and health costs for employee retention credit periods. And it's the first $10,000 is what is qualified for employee retention credit. So, and actually, it's not the first $10,000. It's $10,000 is what you can qualify, and then for 2020, it's 50% of that, so you get $5,000 a year. But if you have a highly paid employee who you could only qualify $100,000 of their salary for PPP forgiveness, but they made more, say they made $120,000. The amount in excess of $100,000 could be qualified for employee retention credit, because that is not an eligible wage for PPP forgiveness, but it is eligible. The first 10,000 or that next 10,000 would be eligible for employee retention credit. look at cutting off your PPP covered period as soon as you can. As soon as you've spent the money, cut it off. Don't, originally it was, well, we might as well just go the full 24 weeks. If you haven't applied for forgiveness yet, then, do the analysis to say, how long do I really need my covered period to be? When can I cut it off? And I know originally when the loan forgiveness applications were being processed by the banks said, well, it's either 8 weeks or 24 weeks. You can't give me something in between. We want all of the information. The Consolidation Appropriations Act that was passed in December made it crystal clear that the covered period can be any time in between 8 weeks and 24 weeks. So now the banks are, I know, have rejiggered their portals to accommodate that. There are some ordering rules. If you don't apply for PPP forgiveness, the employer retention credit is deemed first. If you apply for the employer retention credit before you apply for loan forgiveness, the wages that you put on that employer retention credit application, if you will, are considered to be for employer retention credit, and then anything that would be left over would go to PPP second. However, PPP is deemed first if you apply for loan forgiveness or you've already applied for loan forgiveness. And the IRS came out, they recognized that the rules changed. They changed the rules to the game in December. After a lot of people already applied for loan forgiveness and people put excess wages on those loan forgiveness applications, and they said, what are we going to do? The AICPA asked for guidance. Everybody asked for guidance, and they came out, it wasn't perfect, but I think they came out with some pretty generous guidance. And they said, if you have applied for forgiveness, we will assume that the maximum amount of payroll on your loan forgiveness application needed to meet full forgiveness will be applied to PPP. And anything in excess of that, you will be allowed to go back and claim the employer retention credit if you've qualified for it. So for clients that, put excess costs above their loan value on their PPP forgiveness application, can go back and still claim the employer retention credit. If you've submitted your PPP 1 forgiveness application and it's still with the bank, meaning it hasn't gone on to SBA, you haven't gotten that notification from the bank, you can ask the bank to pull it back and see if you can amend your application, if you will, to rejigger what expenses you want to put on that. If you applied for loan forgiveness and you did not include any of the non-payroll costs, the SBA and the IRS have said you can't pull it back and now change what you're putting on your application. Once you've submitted the application and it's gone on to the SBA, if you left eligible costs off the original application, too bad. There's nothing you can do to change it. And that was the piece of guidance that I think a lot of people were hoping they were hoping the guidance would allow you to pull that loan forgiveness application back and change the numbers that you put on it. I recognize that the SBA and the IRS, these past 12 months, just like everybody else, have had a pretty heavy burden with all the new laws that have been passed, and the SBA monitoring or really administering this payroll protection program with no new resources. So I think the guidance came out because it would be too much to try to figure out which applications are going to get amended, and they wanted to draw a line in the sand and say, if you left off eligible costs of your original forgiveness application, too bad, we can't help you. But if you put all of the expenses on your loan forgiveness application and your loan was, $2 million, and you put costs of $3 million on your loan forgiveness application, will allow you to go back and claim the credit.
Sarah, well, one of the things that was really punitive for a lot of clients, and I'm sure a lot in the audience, that they had their PPP loans, they wanted to get the forgiveness in, and they just threw all wages onto their PPP forgiveness app because they didn't need all those other costs, and they didn't see any reason to dig into those lease agreements and everything else that you needed to do in it. And it has turned out to burn a lot of people. So if you're in that, I guess misery loves company, So if you're in that category, you're not alone. There's a lot of people that I've talked to that have dealt with the same thing. And unfortunately, you got to deal with what you have now.
Yeah, it is unfortunate. So in this example, so we're going to go through a couple of examples here, and we'll talk a little bit about PPP second draw considerations as well, because, a lot of companies qualified for PPP round 2. And, now they're saying, well, should I apply for PPP round 2, or I've applied for PPP round 2? How is this going to impact, the employee retention credit? And we'll talk about that in a minute. But this is just an example for the first round PPP if your loan forgiveness application was already submitted. So we'll assume that this borrower meets the requirements for employee retention credit. However, back in April, they didn't pay any attention to the credit because you couldn't take both. But they submitted their loan forgiveness application. They put $1 million of payroll costs, $400,000 of other qualified costs. And they had total costs reported on their loan forgiveness application of $1.4 million. They had an FTE reduction, so they had to reduce those costs to a modified total. And this is how, if you haven't taken a look at the loan forgiveness application, this is really just how the math in that loan forgiveness application works. So the modified total of qualified costs is $1.26 million. And they had a loan amount of $1 million. So the SBA and the IRS said, in this instance, you need to 60% of your costs need to be payroll to achieve full forgiveness. So the IRS said, we'll assume that $600,000 of the $1 million of payroll costs are for PPP loan forgiveness, and the other $400,000 will be eligible to claim the employee retention credit. So this borrower could go back and amend payroll tax returns to claim a credit for $400,000 of wages. And remember, again, it's $10,000 of wages per employee. So it would depend on what the mix of that was, how much credit they would generate here, but they will allow you to go back and say, even though you put $1 million on your loan forgiveness application, we'll allow you to take $400,000 and apply it for employee retention credit. So second draw considerations, same borrower. Most of our clients, if they got a second draw loan, it was the same amount as the first draw. So second draw loan is $1 million. And they're looking at it saying, okay, over the next 24-week period, I'm going to have $2.4 million of payroll costs. And I'm going to have $400,000 of other costs. So if I use a full 24 weeks, I'm going to have $2.8 million of qualified costs that would be eligible for forgiveness. We know that the minimum payroll cost for forgiveness in this instance would be $600,000. So this borrower would have up to $1.8 million worth of wages that would qualify for employee retention credit. And so, you will want to go, before we're modeling this out right now, because I have some clients who they're like, Q1, I'm for sure going to qualify for employee retention credit. My gross receipts aren't going to recover yet. Maybe they'll recover by Q3. So they're saying, okay, well, if I qualify in Q1 and I qualify in Q2, do I have a pool that's big enough with the remaining covered 24-week covered period after Q2 to achieve full forgiveness? And these are the models that we're running. Most of my clients didn't get their second draw PPP right away. So a lot of them said, well, we qualify in January for sure. My covered period is going to start on February 1st. So we'll take the ERC. Originally, they thought we'll take the ERC in month 1, and then month 2 and 3 we'll allocate to PPP. But when the IRS guidance came out and said you can really pick and choose which wages you want to qualify for what, they're now looking at delaying sort of when they're going to allocate wages to PPP. But we're going to model the numbers for them. We're going to factor in, when do they qualify for the gross receipts reduction? When do they anticipate not qualifying for it? Because what we want to do is maximize that $1 million loan forgiveness and get as much employee retention credit as you possibly can. The
One of the
one,
things that I find when I'm consulting on these, the first step is really to do your gross receipts by calendar quarter, starting in the beginning of 19 all the way through today. So that's the first step, so that you can determine, do I have a gross receipts trigger that provides me an opportunity? The second is, if you've been shut down or partially shut down, identify which quarters you had the partial shutdowns or shutdowns. Once you have that information, then it gets to a timeline. And you lay those out on a timeline with your PPP covered periods. You know when you got PPP 1, when the amount came in, and you know what your covered period is, and the same thing on PPP 2. And then the strategies can start to you can see where the overlaps are, you can see where it works, and that's the easiest way to do it. But get your base information down, which is your gross receipts. You know, that's usually the cornerstone, or the shutdown periods. That'll help you dramatically.
yeah, you know, the other thing, because you can choose which wages you apply to what. So in 2021, if you have an employee who makes $40,000, right, then you, without PPP second draw, if you've met that 20% reduction in gross receipts for every quarter at a $40,000 wage base, you would generate $28,000 of tax credit for that employee during the year. Now, if that employee made $80,000 and you did second draw PPP2, you could qualify, you know, for 24 weeks, maybe 50% of the wages for PPP2, and claim, you know, the first 20 for ERC during that covered period. You know, if it's Q1 and Q2, you can pick and choose the wages that you qualify for each. The loan forgiveness application will probably be a little bit more cumbersome, because you'll have to provide reconciliations to the bank to show them how you're navigating that. But the payroll processors or the payroll providers are pretty adept at helping you navigate that and running the reports for you. I haven't seen them yet. I don't know if they're still being they're still updating their software, but I do know that, you know, I think it's ADP is saying, hey, if this qualifies for employee retention credit, you check a box so that they can track it for you. So it'll delineate between what's employee retention credit and then what's qualified wages for PPP loan forgiveness. So there's ways, you know, there's multiple ways you can qualify for both. It's really sitting down and understanding what are your payroll costs and how can you allocate some to both PPP and ERC, just not double dip on those wages. Again, I sort of mentioned it, your employees that are making over $100,000, when you're, you know, for PPP forgiveness, you can only qualify the first $100,000. Anything above that first $10,000 above that, you can qualify for employee retention credit. So there's a lot of ways you can do the analysis and run those projections to maximize both. I have a client who they believe they're going to generate around $700,000 of employee retention credit a quarter and still meet their full forgiveness on the second draw PPP in 2021. So it's, you know, the numbers can add up really very quickly once you start doing the math.
Sarah, question. I know we've got a lot of manufacturers out there that might be getting the R&D credit, I don't know what you call it, research and experimental. Any issues there relative to this?
Yep. I was just going to get to that. So there are, you can't, the way the legislation is written now, you can't qualify if you have wages that are qualified for employee retention credit, you cannot take the deduction. So there will be a tax impact for those same wages. So if you all of your employees met the maximum wage base to qualify for employee retention credit, that would be a $40,000 reduction of wages for tax purposes. And if the wages aren't deductible for tax purposes, you can't claim the R&D credit on it. So it doesn't let you double dip on credits on the same wages. Same thing with if you have work opportunity tax credit, you can't claim the employee retention credit and the work opportunity tax credit on the same wages. So it will impact, you know, you do have to run those analyses to say, am I going to generate enough employee retention credit to offset the reduction in my research and development credit or a reduction in my work opportunity tax credit, there is some additional analysis that you do need to do there. Last thing we're really going to talk about is, how do you claim the credit? We talked a lot about the credit. How do you claim it? We mentioned at the top, it's a refundable payroll tax credit, and it's claimed if you qualify for second quarter 2021. The way the legislation is written is what it does is allow you to reduce your federal payroll tax deposits. So your federal income tax withholding, FICA, and Medicare. And that's so you can realize that cash right away, in real time as you're paying payroll, you could see that benefit right away. You don't have to wait. If it's too late, we're already coming into the end of Q1. So if you didn't know about the employee retention credit, you didn't know to do that, you file on your 941. There's a place for it. There's a worksheet. You don't have to submit the worksheet with the 941, but there is a worksheet that helps you go through the calculation. And there's a line on the form 941 now for employee retention credit. What that will do is you'll end up getting a refund, or you can carry forward your excess payroll tax deposits, right? So you've been submitting these payroll tax deposits all through Q1. You can carry it over to the next year or to the next quarter, so that you can start recognizing that cash benefit right away. So if you were going to qualify in Q1, but you don't qualify in Q2, you would still have an overpayment on that 941 that would allow you to not remit your federal withholding, FICA, and Medicare until you'd have to analyze when's that overpayment going to be absorbed, and then start remitting those deposits again. You can file Form 7200 if your employee retention credit exceeds your anticipated payroll tax deposit. That is an option that's out there. And then for 2020, you would have to go back and file amended 941s to claim those credits. You don't need to attach any supporting documentation to claim the credit. It just goes on the line for the credit on the 941. You just need to maintain the support for your eligible costs, similar to what you're doing for your PPP. I will say that the IRS is processing amended returns probably pretty slow. I know that Treasury and Congress are putting pressure on the IRS to try to process these amended returns a lot faster. But if you haven't heard, I think the IRS still has 6 million tax returns from 2019 that they need to process. So these things may take some time to get through the system.
And Sarah, one of the things that I've seen as well as many are recommending that there is a box that you can apply your 941 refund forward to the next quarter.
Yep.
So you can use it up in the next quarter if you think you can get the money back faster that way, because the refunds are taking so long on the 941Xs. And we're coming up to March 31st, where your payroll providers are all going to start doing these 941s. So you need to get the analysis done now before they start moving forward on these 941s, so they can catch it on this Q1 941 and not have to go for an amended return if you're too late in your analysis.
Yeah, I would definitely have your payroll provider. If you're using a payroll provider and you think you qualify for this credit in Q1 2021, I'd call them immediately and make sure that they don't process that payroll tax return until you're able to do the analysis. I forget what the due dates for payroll tax returns are. I think it's the 10th of the fall. I think it'd be due April 10th, somewhere around there. So you have a little bit of time to get that analysis done before that payroll tax return is due. And if you're uncertain if you're going to qualify for Q2, remember that you can use the immediately preceding quarter. So once you know what your Q1 gross receipts are, you'll know if you qualify for Q2, because you can just use Q1 as your measurement to determine qualification. And then you can stop withholding, you can stop remitting those payroll tax deposits right away. So it's worth doing that analysis.
Sarah, I'm getting some questions from people on how long do they have to amend the 941s? And the statute of limitation is 3 years, like a normal federal tax return from the due date. So you have time, but I guess sooner than later you want to get those in so that you can see what.
The sooner you get them in, the sooner you're going to get cash.
Yeah.
But Yeah, 3 years. I think there was some question as to, is it 3 years from the quarterly filing or is it 3 years from the annual filing? And I think it's the annual, once you because you file a quarterly payroll tax return and then you have your annual one that's due after the end of the year. And I think it's 3 years from that date.
I've answered around 22 questions so far that are out there. There's no open ones. Well, there's a couple open ones that just popped up. Let's take a look at those. One of them, they were asking about, do you have to be cash? When do you recognize? I get this credit that's coming through. When am I supposed to recognize it on my tax return, the refund? I'll see if you answer it the same way that I typed it in on my answer. I thought it was more of an accrual basis or cash basis taxpayer. If you're accrual basis and you applied for the refund, you probably should accrue it at a 12/31/20. If they were in 20, you should accrue it as part of an accrual basis. If you're cash basis, you recognize them as cash. That was sort of the thought process. I'm not sure what your thoughts are on that.
I think you nailed it.
Okay, so that's good that you didn't counter me on that one.
It did not. Nope.
I've got a question right now. If you're a fiscal year taxpayer, do you use your quarters or calendar quarters? And the answer there would be calendar. Calendar quarters are what you're supposed to use to look at it. It's not the fiscal quarters. Let's see. You might want to scroll through. We've got around 8 minutes left on the answered 22 questions that are out there. Sarah, you might be able to see some. There's another one that's out there. Now getting back to the cash basis tax here, I think this is the appropriate way for the IRS to recognize the non-deductible expense for ERTC credit. Now this is a little bit too much detail for, I'll answer that separately. Other costs. Do we have a specific list of additional other costs allowed for forgiveness of the PPP allowed for PPP2? PPP1 versus PPP2. Do you have a list of those other costs that are out there?
So to be clear, there is no difference between what costs are qualified for PPP1 compared to PPP2. It's just that the IRS and the SBA have expanded the definition for both. So you can put those costs on both loan forgiveness applications. And it's stuff like software costs, like if you have accounting software that you use and you're paying a licensing fee, those types of costs are now qualified. Same thing if you have like an HR software type system, those costs are qualified. Some supply costs are qualified. It's a lot. Yeah, we do have a list. I don't know it off the top of my head. Jim, I don't know if you do.
Don't have one off the top of my list, but I think that's something that we can follow up with.
Yeah.
Maybe when we put the materials out, we'll add a list to that or fire that to that question, that specific question, try to answer it as we come through. We've got 6 minutes left. See on any of the answered questions or anything else, we can go back through the whole group. They had one that was partially shut down from March 23rd to April 6th. So the wages for the period 1/1 to 3/1 paid on 3/31 eligible to apply towards the credit. The entire wage was paid on the 31st. And I think the payment, the date is the critical part there, that if you paid it on the 31st, that you would qualify. That was my answer. I'm not sure if you agree with that, Sarah, whether it's supposed to be 3/13/20 moving forward.
Yeah.
The credit applies on wages subsequent to that. Do we have to cut off at 3/12 and throw those wages out, or do we take the wages that were paid on the 31st if they were paid on that date?
Yeah, I don't know that detailed answer off the top of my head.
Okay, so we'll have to take a look at that one to see if I answered it correctly. I was thinking it was on a cash basis, but I know they have a specific cutoff on the 12th and before, so those wages possibly could be thrown out, but I'll follow up on that one as well.
Yeah, I'd have to look to see if the language is wages earned or wages paid. If it's wages paid, then I think you'd be fine for anything paid after March 12th.
Yeah.
If it's wages earned, then you wouldn't.
I had some ask if we had anyone file a Form 7200 and how long does it take? I haven't had any file for a 7200. I think some people are confused that they describe it as you can get the full credit up front, but I think you're supposed to, per the instructions, look to see if you can reduce, if you have excess credit that you can't reduce your deposits by, then you can file the 7200. And my understanding is they're taking longer than the the 941Xs. So it's taken a long time, 4, 6, 7 weeks to get these refunds back. So you want to try to reduce your deposits if at all possible. That's the best way to get the money in your pocket, or apply the refund to the next quarter and pick it up that way. It'll be quicker.
Yeah, that's what I would do. I would apply it forward to pick it up quicker. I don't have anybody that's filed the Form 7200, but you're right in the order that on that ordering rule, it is, you only file that form for amounts in excess of what your payroll tax withholdings would be. And I don't have anybody that's been in that situation where their credit was in excess of what they would be remitting.
And the credit itself, many have asked, well, how do I recognize this? Is it taxable? Yes, it is taxable. It's a reduction of the wage or the healthcare costs that you're getting the credit on. So it is a reduction of the expense. So the ERC refund that you get is a taxable amount. So if you're getting $700,000 in refunds or reducing your payroll tax expense, it's a reduction of expenses on your tax return, and you're going to pay taxes on that amount. So it's you'll have to, I guess, take, depending on what your tax rate is, take 66% of the refund amount or 70% of the refund amount, and that's your anticipated net benefit in your pocket that is available to you as you move forward.
Yeah, you do have to tax affect it to see what your net benefit is. There's no doubt. I had a client ask me, should I just not even apply for loan forgiveness and just go after this employer retention credit? And I said, well, loan forgiveness truly is free money because there's zero tax impact now. And it's free money. Whereas the employer retention credit will trigger a tax. You do have to tax affect it. Both federal and state. Don't forget about the state. Most states start with federal taxable income. I don't see any state non-conforming to this particular rule on the employee tax credit, because that would be them, reducing their revenue, and that would be unlikely to happen. So federal and state tax effect should be considered on it.
We've got a couple more questions here. We got a couple more minutes. We were shut down for 5 weeks in 2020. We paid 2 health insurance bills during that time. Can we claim both of those bills for ERC? I guess they're trying to say, can we get ERC on the 5 weeks that we were shut down? Yeah. If they stayed home and no one was working, you qualified get those on those health insurance costs that are associated with that 5 weeks that you were shut down. Yeah, you do.
Yeah, this is where some of my larger clients have qualified. They didn't meet the gross receipts reduction, or they did, but they're too big, and they didn't really pay anybody to stay home, except for during a few week period in the end of March, beginning of April, while everybody was still trying to figure out what was going to happen. They either paid their employees during that time, or they maintained their healthcare costs, and those healthcare costs for sure would be qualified for the employer retention credit. You just have to be careful that you didn't also include them on a PPP loan forgiveness application, or if you did, and you had excess costs in there, then you can pull that back and say, these are the wages that I'm going to qualify for employee retention credit. I'm going to, I have this excess pool of wages that I didn't need on my loan forgiveness application. And so that part I'm going to say is related to these healthcare costs that I paid while we were shut down.
Yeah, I think we're running out of time. So Mike, any wrap up items that you got here?
Yeah, no, thank you, both Jim Biehl and Sarah Russell. What an amazing presentation. Thank you for that. It sounds like there's a lot of money to be saved, and your help will no doubt help manufacturers achieve that. So I want to tell you that the web webinar will be sent out again in 24 hours. It's available both on the MMA website and the Clayton McKervey website. But what a great presentation, and we thank you for that. Reminder that both Jim and Sarah have agreed to kind of stay on the Q&A chat function for a few minutes to answer any question you still may have, though they seem like they've answered, I don't know what the total number is, 25 or so, maybe 30. Anyway, we'll shut off the video, but continue to fire your questions and they'll be there to respond. So thank you all for attending, and go out there and get some money. Thank you very much.